So not too long ago, about a month or so ago, I had a subscriber of my YouTube channel. He reached out to me to share his trading results with me, and these results are a result of the credit spread strategy that he had been using after watching my video. So basically, he has been using the bull put spread strategy that I have shared on my YouTube channel. And as you can see over here, he has done pretty well. So he shared with me this trades that he have taken so far, roughly about 22. And so far, he had about 20 wins and only 2 losses, which gives a win rate of 90.91%. So this is pretty good. But this is, of course, during the time where, the market was still going up and the market has not come down yet. So it's only normal that you will have a little bit more losses when the market starts to come down. But again, over the long term, it's going to be profitable as long as you stick to the mechanics. So what are these mechanics? What is this strategy that he's using that he saw off my channel? So this is actually a very simple bull put spread strategy, and it involves 3 steps. So the very first step, all you got to do first is just to look at the oversold signal. So basically, you want to find an indicator that actually shows you the condition of the market, whether it's overbought or oversold. And there are a few indicators for this, right? You can use the stochastic oscillator, or you can use the RSI, or any indicator that tells you the overbought or oversold condition in the market. So the first thing you want to do is to look for the oversold condition, because we are using the bull put spread. So the bull put spread is generally a bullish strategy. So it's better for us to enter when the market is oversold rather than when it's overbought, because that's the time when the market has already gone up quite a bit. So we want to enter when the market is considered kind of oversold. Now, of course, that's not to say that the market won't go more oversold, but at least it's a much more strategic place for you to enter into a bull put spread compared to, the other types of the market condition. Now, the second part to this, the second step, is to look for support. So this is another very important criteria you want to input as you start to trade this strategy as well. Because if you were to just trade the oversold part and then just enter based on that, there'll be times where the market can really go all the way down. But if you implement it with the support, then at least there are places where the market can actually bounce off the support and then go back up again. Now, of course, not all the time the support will always work out. There'll be times you'll break through the support, especially during times like this. But again, over the long term, right? Let's say, for example, you take over 100 trades, over 1,000 trades. This is where the edge can be on your side. You see, you want to pile more odds on your side in your favor to let the edge play out over the long term. And finally, number 3 is to sell the bull put spread below the support. So this is very important, because if you were to just randomly place the bull put spread anywhere on the chart, then of course, there's always a chance that the market just run through it. But if you put all these 3 steps in your favor, once it's oversold, you identify the support and you place the bull put spread below the support, then there's a higher chance that the trade is going to work out. So as you can see, this subscriber over here, that's what he did, and he managed to get pretty good results. Now, this is for the entry. Now, what about the exit? So for the exit, it's actually pretty simple as well. Now, there are a few ways that you can do it. The first way is that you can go according to percentage. So the first way is a percentage exit. That means to say you have maybe 50% take profit, or 70% take profit, 90% take profit, whatever it is. So for example, if you sold it for, let's say, $2, that means you get $2 in credit. So if you want to take a 50% profit, then what it just means is that at $1, you just close out the trade and then you realize half of the profit. So that's one way. And the second way is based on DTE exit. So this is something that the Tasty Trade team has actually did a very thorough study on, is that when you exit at 21 DTE, not only does it give you a much superior result, but at the end of the day also it reduces the chance of getting early assignment. Because if you're trading on all these individual stocks or even the index ETF, if your bull put spread is going to be in the money, and if you were going to hold all the way close to expiration, there's always a chance for you to get assigned, and that's where you could get into margin call. So if you implement the DTE exit, at least the chances of getting assigned is not so high, because you already got some extrinsic value. Now, the third way is a discretionary exit. So this one really comes down to you as the trader to see how well your skill is. Maybe you want to use some technical analysis to exit some indicator, whatever, right? So this really comes down to you. So you can use either one of this or maybe a combination of either of this. So next, let's get into the actual trades and take a look at how this subscriber actually plays his trades. So let's take a look at the very first trade. So his very first trade is a loss, and I would say it's actually most likely the only loss that he had so far out of these 22 trades, because although this is a loss down here, if you take a look at the actual credit and what he actually closed at, it's actually a profit, right? As you can see over here, he opened at $1.90 and he closed at $1.85. So this should give you actually about 5 cents profit, but maybe because of commissions, it ended up in a loss. So as you can see over here, so the only loss that he really technically have is on SPY. So let's take a look at SPY. So he placed this trade in December, so 18th of December. So let us head on over to SPY. Let us take a look. So 18th December, where is the trade? So it should be somewhere around here. So 18th December is here, as you can see. Below, you can see the date says 18th December. Now let us take a look at what he has done. So he has entered somewhere around here. So remember, what we want to do first is identify an oversold condition. So 18th December is not exactly oversold just yet, but for some reason he entered it, because if you wanted to wait until oversold, it would be probably somewhere around here, and that should coincide with sometime maybe around 20th December. So maybe he had a preemptive entry. Maybe he wanted to enter it a little bit earlier. And the second part to this strategy, remember, is to identify the support. So we want to identify the support. So how we do that? We just go back to the past and see where's the place where the market, bounced off and then go back up. So because the price has actually kind of break past this previous low down here, we won't actually consider it. We want the one that's more distinct. So as you can see, it should be this one over here. So the whole idea down here is to identify it as oversold, find the previous support, and then you want to sell the bull put spread below the support. That means to say you want the bull put spread to be something like this. As long as it's below the support is ideally where you want, because if the market was to come down, at least there could be a chance that it bounce back up again. So as you can see over here now, of course, not all the time it will work out. So you can see this is where it will go all the way through. And then, but there's still some time, right? Let's say, for example, you enter here, it's oversold, you look at this support, then there's still some time. Maybe eventually after the market ended up in the positive again, you could take profit. So let's take a look at his trade down here. So the other thing, by the way, I forgot to mention is maybe you could zoom it out again and look at the other support area as well. So this is another support area that I'll probably be looking at. So as you can see, it's oversold again. And then same thing, if you were to enter sometimes over here, let's say the market came down here, and then you look at the market now, look at this support down here, you want to sell the bull put spread below here. Okay, so let me just remove all this drawing. Let's just go and take a look at what he did. So let me see what are his strike price that he took. So 18th December he entered 588 and 578. So let us take a look at where's 588. So let me just use the drawing tool over here. Let's put the line 588 and 578. Okay, so 588 seems to be quite high up over here. So this is not below any support from what I can see. Let me just very quickly put 588 over here. Let us lock it so I don't accidentally move it. Clone it. And then let's put 578. 578. Okay, so this is where his bull put spread is, short put and long put. Now, this is not exactly according to the criteria I've set out for the strategy, because as you can see, there is no support that he have used. He actually entered it somewhere here. And then over here is really the first support, and further down would be the second support. So the second support is a little bit too far away. So I'm not sure why he actually entered here. Maybe it was a mistake or what. But the market did actually eventually did go up a little bit. But for some reason, he actually took a loss. As you can see over here, he took a loss and he was out. So I'm not sure how he actually exited this one. But I would say if you had actually placed it according to the strategy, that means to say, let's say you put it using this as the support and you put the bull put spread below here, then there's a chance that this would be in a profit because the market would have gone up and you had a chance to take profit over here. So I would say technically this trade, if you go according to my strategy, it shouldn't be a loss. Okay, so that's for SPY. Now let's take a look at his second trade. So his second trade is Meta. So Meta is done on the 24th of December, Christmas Eve. And his strike price is 535,525. So end up in a profit. Let us take a look at Meta. So Meta, where is Meta? Okay, so this is Meta down here. He took it on the 24th of December. Let us take a look. So 24th of December is somewhere here. Okay, so this is where our first criteria has been met. The market is oversold. Now let's take a look at the support then. So over here, support will be over here. So as you can see, this is the support. Now the goal is to sell the put spread below here. So let us see whether he has actually done that. So let us take a look at his strike price, and it's 535,525. So let us go to 535,525. Let me just change to this cursor over here. 535 horizontal. Okay, very nice. As you can see, 535. The short put is nicely below the support area. And I won't draw the long put because it has not even breached the short put. So we know this is not going to be a loss. As you can see, the market just went up after he placed the trade. So he placed the trade sometime around here. So should be somewhere here. And then after that, the market went up. So very nice. Okay, let's take a look at this next trade now. By the way, if you like this video so far, please subscribe and also click the thumbs up button. And also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Which is on as you can see, bull put spread is on 110-100 and 24th December as well. So the same as well during Christmas Eve. So let's take a look at where the trade is. 24th December, sometime around here. So yes, the first criteria has been met. It is oversold, very nice. And without even plotting out the support, which is somewhere down here, I already know that this trade is going to be profitable, because the moment he took on this trade, as you can see, the moment he put on this trade, the market went up. So it's very easy for you to quickly take profit on this. As you can see, the market really shot up. So it'll be pretty quick for you to actually take profit. Again, up to you where you want to take profit, whether it's at a percentage or maybe it's at a certain DTE, 21 DTE ideally, or maybe some technical analysis or indicator you want to use to exit it. So in the end, it's really up to you. But as you can see down here, the entry is really very ideal, very optimal. The moment he entered it, the market went up. So let's just take a look at his strike price to see whether he actually placed it below this support. So 110-100. And yes, you can see 100 is over here. So it's nicely below the support line. So as you can see, the market went up. Now, as you can see over here, the market towards the end down here, it's oversold again. So oversold, usually this is where you can have an opportunity again. So same thing as well. Once it's oversold, so let's take a look at where the oversold happens. So it's somewhere around here. So oversold happens around here, but you don't want to immediately just sell the bull put spread. As you can see over here, the moment if you were to sell the bull put spread, if it comes down here, then you would likely be in for quite a ride, because the market would have just gone through your bull put spread if you just placed it very, randomly or arbitrarily. You want to identify the support again. And the same thing, you can use this support, or maybe you could use this support as well. But since they're so close, I would prefer to use the one that is further away. So if, let's say, for example, at this point down here, you find that you cannot find a bull put spread with decent credit that is below this support down here, then don't enter into it. All you got to do is just wait for the market to go further down, closer to where the current support is. Then you take a look at the option chain. And if the option chain actually gives you a bull put spread structure with decent credit, then you can enter into it. So as you can see over here, the market is basically hesitating or stalling around this price down here. So whether will it go up or it goes down, we have no idea, but we just go according to the strategy, and we have already put the odds in our favor. So again, it's based on the oversold indicator, already oversold, and then the support is down here, and then you just place the bull put spread below this. So then again, you have the odds in your favor. Chances of the market actually going back up is higher, at least compared to it going down. So again, like I mentioned, losses is going to happen, but you do this consistently over time, you're going to have this work out for you. Okay, so let us take a look at his next trade. Let's see his next trade. Next trade, okay, let me just go to the other trades. I'm not going to go through all because there's just too many. Okay, let's take a look at it's one of his biggest profits that he have, which is on Netflix. So let's take a look at Netflix, which is entered in January, 7th of January. So this is Netflix. So as you can see, straight away, I can see that this is going to be a profit already because the trade over here is oversold and it's 7th of January. So 7th of January is somewhere around here. So 7th of January is oversold already. As you can see down here, oversold. By the way, this is the stochastic oscillator if you're wondering. If you're wondering what's the settings, I also have a video on it. Just go to my channel and type stochastic oscillator and you'll find a video where I share the exact settings. So he entered somewhere around here. So now there's one issue over here is that we need to identify the previous support. And as you can see over here, the market just pretty much gone up quite some time from somewhere mid-October to around December. And the only support area, I would say, the real support probably will be somewhere here or somewhere down here. And I'll prefer usually around this price down here. This is where it bounced off. So he actually entered somewhere around here and there's not any real support. So while you can actually do this, but as you can see in the previous stock which I showed, if you were just to enter based on the stochastic, sometimes it will work out, of course, but there will also be times where you just blow through your trades because there's no real support to kind of have any bounce off. So he entered into this trade and the market actually did go up. So this trade had worked out for him. So let's take a look at what is the strike price that he chose for this. So this is based on the Netflix. So it's 810-800. So let's take a look at 810. So 810 is somewhere around here. So okay, this is pretty nice. So he actually found the strike price of 810. Okay, let me just very quickly draw the line down here using this. 810 is somewhere around here. Let me just use the short put only. So 810, let's put the 810 down here. Let's lock it in place. So it's very nice. I think what he did is that he used this candle down here, a small slight movement down as the support. So you can do this as well, but generally, like I mentioned, I prefer the support, which is much more clearer, somewhere around here or the one below. So the trade worked out and he was in profit. Okay, now let's take a look at his other trades. Okay, let's take a look at Apple. This is the one where he had very slight profit. Let's take a look at what he did. So this is also on 7th of January. Let's head on over to Apple. So Apple is an entry on 7th of January, should be somewhere around here. So as you can see, it's oversold. Very first criteria has been met. 7th of January, let's take a look at the date below. Okay, 7th of January is somewhere around here. 7th of January. So his entry should be somewhere around here. Then the support which we are looking out for would most likely be this one. As you can see, price did bounce off here. And the next support will be somewhere around here, which is where the current price is. So this is a little bit far from where the first initial support is. So generally, if you find that the support is too far away from where you identify the oversold condition, then just wait for the market to come down. So as you can see, the market came down, and this is where it can give you a better opportunity to enter into a bull put spread below the support area. So let us take a look at what is the strike price that he chose for this. So it's 235.225. So 235.225. So it's somewhere around here. 235, and then 225 somewhere around here. 225. So this is his short put, and then his long put over here. So he actually managed to get out for a slight profit, or rather break even, and most likely is because he just held on to the trade. So you can see it's most likely if you held on the trade, the market eventually gone up, you could have exited for a break even, maybe even a slight profit. So this could be a DTE exit or just based on percentage. So this is for Apple. Okay, I'm not going to do too many. Maybe I'm just going to do one more. So you get the idea down here. So once you have all these three conditions in place, then the trade is going to be a high probability one. So let us take a look at just one last one. Maybe let's take a look at, let me see what we can find down here. NVIDIA. Okay, let's take a look at NVIDIA. NVIDIA over here. Let me just head on over to the chart, remove all this. NVIDIA is over here. So NVIDIA, like many of the other stocks, had quite a bit of a sell-off. So let's just see how he entered into this trade. So what is the date he entered? 14th of January. So 14th of January, somewhere around here. Okay, just nice. So this is where it's oversold. So he entered somewhere around here, which is pretty good. Now, as for support, where do you identify the support? So two support areas. So either down here or down here. So since he entered here, chances are that he probably used this support down here, and you could probably use this as well. So let's just take a look at what is the strike price that he has chosen. So let me just take a look at the strike price that he chose, which is 120,110. So let's take a look at 120 and 110. So 120 is somewhere below down here. As you can see, 120. So let me just draw it out. Let me just plot it out. 120 on the chart, and let us take a look. 120, and then let me lock this in, clone this filler, and then let's put at 110, and let's just see where his bull put spread is. So as you can see over here, this is his bull put spread and is quite a bit away. So you can see this is actually pretty nice because there are two support areas that we identified. As you can see, one down here and the other one below, and he has his bull put spread inside both of them. So you have the short put basically below the top support, and you have the long put below the other one. And he managed to take profit on this because immediately after this, after he entered, the market went up. So you should be able to get some profit. And if you weren't able to exit during this time, there was another opportunity again. As you can see, the market gone up. So again, based on maybe DTE or maybe a percentage profit, this would have given you an overall net profit where you've taken it off, which is what he did. As you can see over here, he sold at 205 and he took it off at around 1.02. So this is roughly about a 50% take profit. So yes, very nice trade over here. Now let's take a look at the recent one. So you can see the market actually come down. So how will you trade it in this current market condition? So let us take a look. So let me just remove this one first, and then we can apply it to the current market condition where the market is going down. So as you can see, market started to come down. So we first identify the oversold region. So as you can see over here, this is where it's oversold. So oversold really happens somewhere down here, maybe somewhere around here, this candlesticks over here. So since this is the candlesticks, chances are that it hasn't broken this previous low. So what you can do, we identify the first level of support, which is this point down here. And as you can see, market did actually come down to this support and bounced off a little bit. So not too sure where it's going to go. Is it going to go up, going to go down? Again, we let the probabilities play out over the long term. It could come down, and if it's time to take a loss, you take a loss. But if it's going to be a profit, then you just take the profit as well. Now, I also want to zoom out again to see where is the other support area. Take a look at this. So this is where we have another support. So we have two support levels down here. So ideally, what I want when I enter into this trade is to find one that is actually below both of them, ideally. So you could have one, chances are that you could construct one that is either like this, where this is where the short put is. So you have one bull put spread that is below the first initial support and the long put below the second support. So in case if it does come down, at least you give it a chance for it to bounce up. And if it does bounce off this second support, then at least your losses, if there is not that big. Because as you can see, if the market actually did bounce off this second support, it wouldn't be below this second long put down here. Now, if you're a little bit more conservative, then I wouldn't go for this first bull put spread. I would want to actually place it below the second support. Then this way, you actually have a much better chance of the market actually going back up. Okay, so hopefully this video has been helpful for you, and if it has, I would greatly appreciate if you give me a thumbs up on this video and also subscribe to my channel for more videos like this, and I'll see you in the next one.